Welcome back to Veiled Wealth. We need to stop looking at the charts for a moment. I need you to step away from the RSI, ignore the moving averages, and forget the colorful lines on the screen that usually dictate your trading day. Instead, we need to look at something far more important. We need to look at the clock. Today is Tuesday, December the 30th, 2025. Take a good look at that date and burn it into your memory, because we are standing exactly 48 hours away from the most significant structural change in the history of the global silver market. We are 48 hours away from the moment the ball drops not in Times Square, but in Beijing. We are 48 hours away from the January 1st China export ban going live. But if you think the market is waiting for January 1st to panic, you are dangerously mistaken. If you are operating under the assumption that the banks are going to wait for the official press release to start running for the exits, you do not understand how this game is played. The panic has already begun. It is happening right now beneath the surface, in the dark pools, in the vault corridors where retail investors cannot see until it is too late. What we witnessed this morning in the span of less than 60 minutes was not a series of random market fluctuations. It was not normal volatility. It was a coordinated systemic seizure. It was a glitch in the matrix that proves beyond a shadow of a doubt that the Western financial system is running out of time, while the Eastern physical market is running out of metal. We are watching two massive tectonic plates collide in real time. At exactly 8:15 a.m. Eastern Standard Time, while most of you were making coffee, the Federal Reserve quietly executed an emergency liquidity injection. They didn't hold a press conference. They didn't tweet about it. They just opened the valve and flooded the banking system with cash. And at the exact same moment, down to the minute, half a world away, the Shanghai Gold Exchange witnessed one of the largest physical withdrawal events on record. You have the United States printing money to save the paper market. You have China draining the vaults to secure the physical market. And you have these two events happening simultaneously, just 2 days before the supply chain locks down forever. Do you believe in coincidences? Do you believe that it is just a fluke that the U.S. banking system needed a sudden infusion of $3 billion at the exact same moment the Chinese industrial complex decided to remove 41 tons of physical silver? In the financial world, there are no coincidences. There's only leverage, and the breaking of leverage. Here at Veiled Wealth, we are watching a tale of two markets reach its absolute breaking point. On one side, you have the paper system in New York, the Comex, the world of derivatives. This system is so stressed, so fragile, and so over-leveraged that it required a $3 billion emergency patch job before the market even opened today, just to keep the gears from grinding to a halt. Think about that. $3 billion. That is not small change. That is emergency room triage. On the other side, you have the physical system in Shanghai, the SGE, the world of factories, of solar panels, of strategic reserves. This system is entering a state of total vacuum. They are not just buying silver to trade it. They are evacuating it. They are taking delivery. They are loading it onto trucks and driving it into private stockpiles where it will never see the light of day again. This is the definition of a squeeze. But a squeeze isn't just a price going up on a chart. A squeeze is when the paper price and the physical reality collide violently. A squeeze is when the people holding the paper realize there's not enough metal to go around, and the people holding the metal refuse to sell it back. And that collision started this morning at 8:15 a.m. If you are holding silver right now, do not let go. Do not let the volatility shake you out. Do not let the sudden drop scare you. The system is blinking red. The alarms are sounding in the repo markets. The vaults are emptying in Asia. And in the next few minutes, I'm going to connect the dots between a $3 billion injection in New York and a 41-ton withdrawal in Shanghai. I'm going to show you why these two events are the same event viewed from two different sides of the war. The West is fighting with liquidity. The East is fighting with gravity, and gravity always wins. We need to talk about the emergency nature of this morning. Usually, when the Federal Reserve intervenes, they do it with a schedule. Today was different. Today, the liquidity appeared unscheduled and off-cycle. This is the equivalent of a doctor rushing into a patient's room with a defibrillator when the patient was supposed to be stable. It tells us that a major bank or a major hedge fund woke up this morning and found themselves short of cash. Why? Because the price of silver and the volatility associated with it is blowing up their risk models. And while that bank was gasping for air in New York, demanding $3 billion to stay afloat, what was happening in Shanghai? 41 tons. Let me repeat that number so you can feel the weight of it. 41 tons of silver, that is 1,318,000 troy ounces removed from the Shanghai Gold Exchange vaults in a single morning. This wasn't trading volume. This was loadout. This was metal leaving the system. This was a Chinese entity, likely a state-backed battery manufacturer, looking at the calendar, seeing January 1st approaching, and deciding to sweep the floor. They didn't leave a single crumb. They took 41 tons of physical inventory out of the public market and moved it into the dark. Why today? Because they know the export ban is real. They are essentially looting the store before the hurricane hits. And here is the most damning part. The smoking gun that we analyze here on Veiled Wealth. These two events happened at the same time. The West needed paper money to cover its bad bets. The East took physical metal to secure its future. It is the perfect metaphor for the collapse of the fiat currency system. The one side prints digits, the other side takes atoms. You have to understand the level of fear required to withdraw 41 tons of silver in one day. You don't do that if you think prices are going lower. You do that when you think there will be zero metal available tomorrow. And you have to understand the level of fear required for the Fed to inject $3 billion on a Tuesday morning. You don't do that if the banks are healthy. You do that when a counterparty is about to default. So we are standing at the intersection of a banking crisis and a supply crisis, and they are feeding off each other. The banking crisis is caused by the volatility in the metals, and the supply crisis is caused by the distrust in the banks. It is a death spiral for the paper shorts, and the clock is ticking. Tick-tock, 48 hours. Every hour that passes brings us closer to the moment China locks the gates. Every hour that passes makes that physical silver in the vault more valuable. Every hour that passes makes those paper contracts in New York more toxic. This is why I'm calling this an emergency alert. This is not business as usual. The data we are seeing today is the data of a system in the final stages of a fracture. The divergence between the paper price, which they are desperately trying to hold down, and the physical flow, which is exploding out of the vaults, cannot last another week. So, if you are wondering why the price is volatile today, stop wondering. It is the sound of a war being fought. It is the sound of the Fed throwing $3 billion at a problem that money cannot fix. You cannot print silver. You can print dollars, euros, and yen, but you cannot print the 41 tons of silver that just left Shanghai. That metal is gone. It is off the board. It has been captured by the East, and the West is left holding a bag of 3 billion freshly printed paper dollars, chasing a shrinking pool of real assets. Let's start by looking at the specific breakdown of that $3 billion. Because when you see where the money went, you will realize just how close to the edge we really are. We have to look at the repo market panic. Why did the Federal Reserve have to emergency print $3 billion at 8:15 a.m. on a Tuesday? In a normal, healthy market, banks have plenty of cash. They lend to each other overnight without thinking twice. But this morning, the repo market screamed. At exactly 8:15 a.m., the demand for overnight liquidity spiked. A major entity went to the window and effectively said, "I need $3 billion right now, or I cannot open for business." This is the financial equivalent of a cardiac arrest. When a bank goes to the Fed for emergency repo, it means the private market has shut them out. It means that JP Morgan or Goldman Sachs looked at this entity's collateral and said, "No, we don't trust you." According to the transaction data, the injection wasn't just a lump sum. $2 billion was exchanged for U.S. Treasuries. $1 billion was exchanged for mortgage-backed securities. Why does this matter? Because it tells us that someone was desperately trying to turn their assets into cash immediately. They were liquidating. They were raising capital. And why do you raise capital at 8:15 in the morning in a panic? Because you have a margin call. And this is where the silver market enters the room. We know that the commercial banks are sitting on massive concentrated short positions in silver. When the price moves against them violently, they have to wire cash to the clearinghouse instantly. If they don't have the cash, they default. So, here's the scenario that fits the data. A major player in the metals derivatives market woke up this morning, realized they were exposed, and the clearinghouse called them for $3 billion. They didn't have it. The other banks refused to lend. So they ran to the Fed. The Fed, seeing a potential systemic failure that could freeze the Comex, stepped in and printed the money. This wasn't stimulus. It was a bailout. It was a specific targeted patch to prevent a derivatives explosion. It proves that the leverage in the silver market has become a systemic threat. But here's the catch. The Fed can print dollars to solve a liquidity crisis, but they cannot solve a physical crisis. And while the Fed was busy swapping $3 billion of paper for other pieces of paper, they did absolutely nothing to address the root cause. The physical metal is disappearing. The Fed didn't print any silver bars. They didn't fill any vaults. And do you know who smells that desperation better than anyone? The Chinese. Do you think the traders in Shanghai didn't see that repo spike? Of course they did. And their reaction was immediate. They went for the jugular. At the exact moment the U.S. system showed weakness, China accelerated its endgame. They realized that if the U.S. banks are this stressed now before the export ban even hits, then the system is going to collapse when the supply actually stops. This $3 billion injection is the tell. The Fed just blinked. They show that they will do anything to keep the game going for just one more day. But while the Fed was fixing the plumbing in New York, a vacuum cleaner was turned on in Shanghai. That vacuum cleaner took 41 tons of silver that will never ever come back to the West. The price of the lie is going up exponentially, and the ability of the physical market to supply the metal is going down vertically. Now we must look at the physical aggression. We have the data from the SGE warehouse reports. It is black and white. In a single morning, 41 tons of silver were physically withdrawn. That is roughly 40 massive pallets of 1,000-ounce bars. It is enough silver to manufacture millions of solar panels. It disappeared in the blink of an eye. This wasn't a paper shuffle. This was an armada of armored trucks loading the bullion and driving it into private state-controlled storage. It is gone. Why today? Because they see January 1st, 2026. They know that in exactly 48 hours, the export ban goes into effect. The smart money in the East is front-running the government. They are securing their inventory before the lockdown. This 41-ton withdrawal has devastated the inventory levels at the Shanghai Gold Exchange. Total registered silver inventory in Shanghai has dropped to 755 tons. That is a historic low. It represents barely a few weeks of industrial demand. The cupboard is effectively bare. If another entity comes in tomorrow and demands another 40 tons, the exchange breaks. They are running on fumes, and when an exchange runs on fumes, the price explodes. This is why the premium in Shanghai is expanding out of control. While the Comex in New York is manipulating the paper price down to $75.32, the physical price in Shanghai has detached, trading north of $80. That is a $5 arbitrage. In a free market, traders would bridge that gap, but they can't. The vacuum operation proves that the metal is trapped, the arbitrage is broken. The Chinese buyers are looking at $75 and laughing. They know it is a lie. They are happy to pay $80 just to get the metal into their possession before January 1st, and the timing it is the smoking gun of coordination. Do you think it is an accident that this massive physical raid happened on the same morning the Fed showed weakness? No. China smells blood. They are twisting the knife. They are making the shortage worse exactly when the banks are least able to handle it. It is a pincer movement. The Fed is fighting the fire on the paper side. China is pouring gasoline on the fire on the physical side. And sitting in the middle is the commercial short seller who doesn't have the metal and doesn't have the cash. This is hoarding, plain and simple. And when the second largest economy on Earth starts panic hoarding the most conductive metal on the periodic table, you do not want to be short. If Shanghai defaults, if they declare force majeure, then the paper market in New York will become irrelevant overnight. But there's a third piece to this puzzle, the paper fraud. While China was moving real bars, New York was trading fantasy contracts. The Comex traded 276,000 contracts today. That is 1.38 billion ounces. That is nearly 2 years of global mining production traded in 6 hours. Do you really believe that 2 years' worth of silver changed hands today? Of course not. It is a digital illusion. Out of that ocean of 1.38 billion paper ounces, only 69 contracts stood for delivery. That is a leverage ratio of 4,000 to 1. For every 4,000 ounces of paper silver sold on the screen today, only 1 single ounce of physical silver actually moved. This is not a market. This is a fraud. They are diluting the price by flooding the world with 4,000 claims for every 1 bar that exists. But the physical vault is empty. And this fraud is exactly why the physical market has finally decided to divorce the paper market. We are witnessing a historic bifurcation. The Shanghai price, $80.72, and the Comex price, $75.32, have split. That 540 spread is a flashing neon sign that says the market is broken. Why aren't the banks buying at 75 and selling at 80? Because they can't get the metal out of the Comex. The bridge has collapsed. The paper price is a zombie price. The physical price is the real price. The industrial buyers know that a paper contract isn't conductive. You can't put a futures contract inside a solar panel. They need the atom. Think about the energy required to maintain that lie. They had to print $3 billion at the Fed and trade 1.3 billion ounces on the Comex just to hold the beach ball underwater for 1 day. Meanwhile, China quietly took 41 tons of real wealth off the table. This 4,000 to 1 leverage is unsustainable. It works until the physical inventory drops so low that the paper claims have nothing left to leverage against. We are approaching the mathematical limit of the fraud. You cannot leverage zero. Let's reconstruct the crime scene minute by minute to see the coordination. 8:15 a.m., New York. The Fed panic prints $3 billion to save a bank facing a margin call. 9 a.m., Shanghai. The data hits that China has withdrawn 41 tons. They waited for the Fed to blink, then they pulled the plug on the supply. 3:30 p.m., Shanghai. The SGE hikes margin requirements. This kills the leverage for Western traders, effectively locking the door. Step 1, the West runs out of money. Step 2, the East takes the metal. Step 3, the East locks the door. This is a siege. It is a coordinated strangulation. And looming over all of this is January 1st. Everyone knows that in 48 hours, the game changes forever. The export ban is the cliff edge. This confirms the thesis veiled wealth has held for years. The price of silver has been suppressed by paper derivatives. But paper derivatives require a functioning banking system and ample physical supply to work. Today, we saw the banking system crack. Today, we saw the physical supply vanish. The mechanism of suppression is failing right before our eyes. If they needed $3 billion to survive a Tuesday in December, what are they going to need on Thursday in January when the Shanghai market opens with 0 exports allowed? So what should you expect in the next 48 hours? Expect violence. The banks are cornered animals. They might try one last desperate smash to trigger stop losses. They want your physical metal because they don't have any. They want you to panic sell so they can cover their 4,000 to 1 leverage. But you must not blink. Look at the data. 41 tons left the vault. Inventory is at a historic low. That is the truth. The price on the screen is the lie. We are witnessing the death of the paper game. For 40 years, they have controlled the price. Today, the truth ran out. China took the last of the truth. When the market realizes the paper contract is worthless, the rush for the exits will be biblical. It won't be a slow rise, it will be a no-offer market. This is your call to action from Veiled Wealth. If you have unallocated silver in a bank account, get it out. If you don't hold it, you don't own it. Today's repo panic proves that counterparty risk is real. If a bank can fail at 8:15 a.m., your unallocated account can freeze at 8:16 a.m. If you are thinking about buying, the window is closing, the premiums are already rising. And if you are holding, stand fast. You are the smart money. You hold the asset that the Federal Reserve cannot print and that China cannot live without. The next 48 hours will determine the winners and losers of the next decade. The Fed printed the money. China took the metal. Which side of the trade are you on? The countdown is almost over. The export ban looms. The paper market is burning. And the physical squeeze is here. This is Veiled Wealth. Stay informed, stay engaged, stay curious.